In order to maximize long-term portfolio returns, investors should regularly evaluate the use of fixed income investments within their portfolio. Fixed income investments generally include U.S. Treasuries, U.S. agencies, FDIC-insured certificates of deposit, municipal bonds, and corporate bonds. Despite today's low interest rates, fixed income investments play a strategic long-term role in helping preserve principal, generate income, and stabilize overall investment returns. By staggering fixed income maturities, an investor is able to provide liquidity for both expected and unexpected needs. Hence, fixed income investments should not be entirely focused on yield, but should also be structured to return principal on the stated maturity date. However, investing too conservatively may expose a portfolio to inflation risk because smaller returns might not keep pace with rising prices. Another reason for using fixed income investments is to reduce overall portfolio risk. When investing in stocks, an investor becomes a company shareholder with no guarantee of either a continued dividend or a rising stock price. On the other hand, fixed income investments specify a rate of return and provide for the return of principal at a future date. However, keep in mind that the risk of default could result in a loss of your investment. Because fixed income investments generally don't move in tandem with stocks, they provide a source of return with generally lower volatility and thus can be an important diversification tool in reducing the overall investment risk of a portfolio. When looking for ways to achieve higher yield, it's important for investors not to assume too much credit risk or interest rate risk. Investors become exposed to credit risk when evaluating the likelihood of a default by the issuer of the debt. The lowest credit risks, such as Treasury securities backed by the U.S. government, are deemed to be risk-free and carry the lowest yields. Treasuries are followed on the risk spectrum by FDIC-insured certificates of deposit, guaranteed by the FDIC up to the amount of applicable insurance. Debt issued by federal government agencies, highly rated municipal or corporate debt, and finally junk bonds or emerging market debt. The highest yielding fixed income categories come from investment in those entities deemed most likely to default. Another way to achieve higher yield is to accept interest rate risk by investing in longer maturities. In normal market conditions, investors are paid higher yields when they are willing to commit their money for longer periods of time. However, if interest rates rise and the investor doesn't hold the bonds until maturity, there may be a loss of principal because bond prices and interest rates move in opposite directions. Because money market funds, short certificates of deposit, and Treasury bills have maturities of less than 1 year, they provide the lowest comparative yield. On the other hand, Treasury bonds and long-term corporate or municipal bonds typically provide the highest yields due to longer maturities. FDIC-insured certificates of deposit, U.S. Treasury and agency securities, municipal bonds, corporate bonds, and other fixed income investments may be purchased through Zions Direct at 1-800-524-8875 or zionsdirect.com.